This is Nightly Business Report with Tyler Matheson and Susie Gehring.
28th record close. The S&P 500 finishes at a new record. The Dow back above 17,000. Is your best bet in this market investing in an index fund that just tracks the market? Or should you try to pick stocks?
In their own words, top Federal Reserve officials speak out on a key issue facing the economy: when to raise interest rates.
Lighting up the sky, why natural gas is being deliberately burned across the oil-rich fields of North Dakota. All that and more tonight on Nightly Business Report for Thursday, August 21st.
Good evening, everyone. A sweet spot for stocks today. The S&P 500 hit a new record and is just points away from the 2,000 milestone. And the blue chip Dow closed above the key 17,000 level for the first time in about a month. The mood on Wall Street was positive today as investors and market pros are feeling confident that the Federal Reserve Chair Janet Yellen will continue to call for low interest rates tomorrow when she addresses policymakers in Jackson Hole, Wyoming. We'll have more on that in just a moment. Now, also adding to the upbeat mood, a batch of encouraging news about the U.S. economy. In the job market, fewer Americans filed unemployment claims. Existing home sales rose more than expected, and a key report on factory activity came in stronger than forecast. Here's a look at the closing numbers. The Dow added 60 points, the Nasdaq was up 5.5, and the S&P rose almost 6 points, closing at that new record of 1992.
The rising market has rekindled the debate over what's the best way to invest. Use a low-cost index fund that basically matches the market, or try to beat it over time by hiring an active fund manager. Well, it appears the people have spoken. In all but one of the past 7 years, reports the Wall Street Journal, net flows into index or passively managed stock and bond funds have far outpaced those into actively managed funds. This year, through July, according to Morningstar, investors dumped $177 billion net into index funds. Into actively managed funds, just $78 billion. Here to tell us whether those investors are making the right choice is John Hale, Director of North American Research for Morningstar. John, welcome. Good to have you with us. So are they making the right choice?
Well, I think for many investors out there, passive investing is certainly a very good choice. You get low fees, you get returns that are, as you say, are going to generally match those of the market. You know what's in the fund, in an S&P index fund. It's great. It's the kind of thing where investors today are looking at the headline of your show and seeing what the S&P 500 is doing. They're going to say, you know what, I feel confident. I know what I'm getting in my portfolio because that's the kind of fund I'm invested in. So there's a lot of good things about it.
John, when you compare the performance of whether it's actively managed or if it's an index fund, how do they rank? I mean, how often do the actively managed funds actually beat out the passive funds?
Yeah, well, it's interesting. I think the problems with active investment performance have been a bit exaggerated, but it's absolutely true that on average, actively managed funds tend to trail passively managed funds, no matter sort of what way you slice it, whether you're looking at, large cap U.S. stocks or in most cases some other areas of the market that have, index options. But kind of the other side of that is that the average actively managed fund doesn't necessarily trail by all that much. And in any given sort of period of time, like we were looking at the 10-year trailing period just earlier today, in the U.S. large cap blend category, the average manager trails by just a few basis points over that 10 years on an annualized basis. And, there are about 30% of the overall universe that's outperformed indexes. So it's definitely possible to find active managers out there. It's also the case that maybe it's not so much... Go ahead. Yeah.
I wonder, because you just said something very interesting. 30%, did I hear you right? Only 30% or roughly 30% of active managers beat the benchmark over time?
Over the last 10 years, yes, as of July, correct.
So I'd have a 70% chance of doing better in something that wasn't actively managed. Do active managers do better in down markets, or do they do better, for example, in more esoteric markets like emerging markets or alternatives?
Well, I think definitely better in esoteric markets like emerging or alternatives. I mean, in alternatives right now, you can't really index alternatives, so any of your passive investing options there are sort of rules-based quantitative strategies that really don't have anyone at the helm other than you know the people just executing it. So you're better off with active managers there. Emerging markets, you know, there are areas of emerging markets where maybe you don't want to be in at the moment, and an active manager is going to take you out of that, whereas an index isn't going to be able to.
All right, John, thank you very much. John Hale of Morningstar tonight.
When it comes to Fed speak, America's central bank isn't speaking with one voice these days. Some influential members say now may be the time for the Fed to raise interest rates. Others say not so fast. And it's all coming to a head at the annual gathering of the world's central bankers in Jackson Hole, Wyoming, where Steve Leisman spoke to many of the key players.
As the Federal Reserve gathers in the mountains of Wyoming to look closely at the U.S. labor market, the debate brewing on the sideline is whether that labor market and the economy are both strong enough to warrant earlier rate hikes. Philadelphia Fed President Charles Plosser thinks it's time for the Fed to move.
I just think we are running a very a risky policy, if you will, given where the stance of the economy is and seems to be going. I would prefer us to begin raising rates sooner and raising them more gradually. But the longer we wait, the more risk I see it as us having to raise rates very quickly in response to a stronger economy and perhaps more inflation.
San Francisco Fed President John Williams says if the economy improves faster than the Fed forecasts, he could see rates rising sooner. But knowing what he knows now, he thinks the current consensus of July 2015 is about right.
I think that thinking around summer of 2015 for the first rate hike is a reasonable guess, given where we think the economy is going and you know, how much progress we're making towards our goals. But again, it really depends on the data. If the data really gets stronger, then it could be a little earlier. And if the data disappoint, it could be a little later.
While the labor market is the subject of this year's meeting, other issues on the mind of policymakers include whether they should be raising rates to ward off excessive risk-taking in markets born of zero interest rates, whether that should be done with regulation or by raising rates, and whether the market is too complacent in thinking rate hikes are a year away.
The economy is already showing signs. So as we look ahead, does the economy look like it's able to sustain this? I think it signals a very important decision point for the committee to say we will have to move at some point. I don't want us to be behind the curve in beginning to normalize interest rates.
The key speech will be tomorrow by Fed Chair Janet Yellen at 10 a.m. Eastern. It'll be her first address to the Jackson Hole Group as the head of the U.S. Central Bank. Yellen will be followed by European Central Bank President Mario Draghi, who could provide some hints as to measures he might take to address the renewed bout of economic weakness on the continent. The world will be listening as central bankers give hints for the policy outlook. And so will some of the local inhabitants, like this moose and her calf in tow, who emerged from the brush outside the lodge just as the Fed meeting was set to begin. For Nightly Business Report in Jackson Hole, Wyoming, I'm Steve Leisman.
Love that with the moose. That is gorgeous. Wow. All right, many Americans don't believe it when they hear that the U.S. economy is getting better. And a new Census Bureau report helps explain why. It finds that many people were in worse financial shape at the end of 2011 than they were a decade earlier. People in the bottom 60% of wage earners lost nearly 7% in household net worth, or about $5,000. But people in the top 40%, they gained more than $61,000.
Oil prices rose today, lifted by those upbeat economic reports we told you about a moment ago. Both Brent and West Texas crude prices moved higher. WTI rose 51 cents, settling at $93.96 a barrel.
One of the reasons oil prices have essentially been capped has been the increased production here in the United States. One of those oil-rich areas, as you probably know, is North Dakota, the Bakken Formation. But with all of that drilling comes some side effects. Morgan Brennan has more.
It's the biggest issue in the Bakken right now, natural gas flaring. North Dakota now produces more than 1 million barrels of crude oil daily, second only to Texas. But drillers are also producing more natural gas, more than they can transport.
The rig behind me is drilling 11 new wells that will all come online around the same time. And this scenario is playing out across the Bakken, and therein lies the issue. More natural gas is coming online than the current pipeline system can handle, and that's why drillers are forced to flare.
Across the region, thousands of wells are burning so brightly that astronauts have captured images from space. The flare rate here is 30 times higher than other oil-producing states like Texas and Alaska, resulting in more than $100 million worth of gas wasted each month.
If you look at the value chain, 95% of the value is in the oil. The gas is 5% of the value part, the revenue side.
Last month, North Dakota passed new flaring standards. By October, at least 74% of gas generated at existing wells must be captured, a number the industry is already close to, but a rate that will increase to 90% by 2020. The rules are causing drillers to search for short-term solutions. For Statoil, the sixth largest player in the Bakken, the answer is a partnership with General Electric and gas logistics company Ferris. Together, they're compressing excess gas and storing it for mobile use, used as a fuel source for Statoil's operations.
We're lowering emissions, and we're burning a cheaper fuel because diesel is much more expensive than the natural gas.
Statoil plans to roll this tech out to all of its rigs next year, and others could follow suit.
Just how effective is this technology? Well, 10 minutes before we arrived here, the flare you see behind me didn't exist. All the natural gas burning off here was moving into the CNG in a box. When you turn that unit off, this 25-foot flare is the result.
Meanwhile, the flaring has drawn the ire of mineral rights owners, many of whom are farmers with flares on their properties.
It's a waste. There's got to be better ways to do it. Most of us are fair-minded people. And if you treat us fair, we're easy to get along with. Don't lie to us. Fair compensation. We're not asking for the moon. We just want to be treated fairly.
More than a dozen class action suits have been brought against the oil and gas industry. But the long-term solution to this problem will take teamwork, as farmers like Wheeler work with these same companies to bring better infrastructure to snuff out flares like this once and for all. For Nightly Business Report, I'm Morgan Brennan in Ray, North Dakota.
Still ahead, Bank of America agrees to pay a record fine, but some say this is the government piling on. Others say the government didn't go far enough. Who's right?
Dow component Home Depot has a new CEO. Craig Menear, the current head of its retail operations, will take over the top job at the home improvement retailer in November. Menear had been widely expected to replace current CEO Frank Blake, who's had the job since 2007.
eBay prepares for a possible spinoff, and that is where we begin tonight's market focus. The company is reportedly getting ready to spin off PayPal. That's its fast-growing payments unit. It might do it as soon as next year. The activist investor Carl Icahn, as you may remember, had been challenging eBay to make just such a move. An eBay spokesperson says the company's position on PayPal has not changed. eBay shares up almost 5%, 55.89 the close there. Wall Street had its first chance to react to Hewlett-Packard's earnings. As we told you last night, the PC maker posted a surprise increase in its quarterly revenue, and CEO Meg Whitman says she's very happy with the results.
Well, it was a milestone for the company. After 3 years, we put up 1% revenue growth, which is, of course, not our aspiration, but it's better than the declines that we've had.
Shares of Hewlett on a nice ride today, up 5% or so to close at $37 on the button. Family Dollar stores rejected Dollar General's $9 billion acquisition offer, saying it would be just too hard to pass antitrust regulators. And it reaffirmed its support for an $8.5 billion offer from Dollar Tree. Dollar General says it's reviewing its options. You need a scorecard for this one. It still believes its offer is better than Dollar Tree's deal and that it could resolve any regulatory concerns about competition. Shares of all three of those dollars fell today, as you see there.
Intuit, the maker of TurboTax, reporting a penny loss in its fourth quarter due to higher expenses. The Street was looking for a gain of 7 cents. Revenues, though, did come in better than expected. Intuit also gave weak guidance for its first quarter. Shares finished up a fraction to $85.81 and then sold off and snapped back in after-hours trading. Salesforce.com's results were better than expected. Revenue rose 38%, and that was helped by increased demand for its web-based sales and marketing software and services. Shares were up a fraction to $55.71 and were relatively flat after the news came out. And GameStop posting better than expected second quarter results, helped by the success of new game releases and strong sales of Microsoft Xbox and Sony's PlayStation 4. Shares closed down 2% of the regular session to $40.49, but then spiked after hours following the results.
Bank of America hopes its mortgage problems are behind it after agreeing finally to a $16.5 billion settlement over its role in the 2008 mortgage meltdown. The U.S. Attorney General Eric Holder calls the settlement an historic resolution that goes far beyond the cost of doing business.
As a part of this settlement, Bank of America has acknowledged that in the years leading up to the financial crisis that devastated our economy in 2008, it, Merrill Lynch, and Countrywide sold billions of dollars of RMBS backed by toxic loans whose quality and level of risk they knowingly misrepresented to investors and to the United States government.
Bank of America says it expects the accord to reduce third quarter earnings by about $5.3 billion before taxes. That converts to about 43 cents per share after taxes.
The former chairman and CEO of Wells Fargo Bank had a lot to say about the agreement between Bank of America and the Department of Justice. Dick Kovacevich says the government's motivation is all political.
This is just simply a political stance and theater that has been going on for 5 years of bashing financial institutions. Again, neither J.P. Morgan or its employees or Bank of America or its employees did anything wrong here. They just bought companies that did wrong. They have big pockets, and therefore they get a lot of political value by having press releases and press conferences.
It's a very controversial issue. Joining us now to talk more about all of this, Christopher Whalen, an investment banker and senior managing director of research at Knowles Bond Ratings Agency. You know, Chris, some people would argue that the government hasn't been tough enough on the banks. What do you think of what Dick Kovacevich was saying, and what do you think of the public criticism?
Well, Dick Kovacevich is absolutely right. I mean, the settlements, Susie, are kind of welcome in a sense that we're finally hearing the Attorney General talk about this, but he's 5 years late. Instead of prosecuting the officers and directors of the banks that did the wrong and that sold bad securities, we're forcing investors to pay for the settlement. The investors are the victims. If you look at the Citi settlement, if you look at the Bank of America settlement, a very large percentage of the funds that are being provided are going to go for modification of loans, donations to worthy consumer groups. But the real victims of the crisis were investors, pension funds, insurance companies, financial institutions. And unfortunately, the politics of this, as Dick said, are really about pandering to consumers. That's the false narrative we're all facing here, unfortunately.
You know, the government would say, I think, by way of rejoinder, though they have not done so, they have not taken prosecutions against individuals, that nothing in this settlement precludes them from doing so. So they could go after individuals, I suppose. And of course, yesterday. No,
they can't, Tyler. I mean, what happened is Tim Geithner, Larry Summers, they all said, oh, we can't prosecute the bankers because of systemic risk. They said this very publicly. And they're wrong. You know, the way you heal the markets and you get investor confidence back is to show people that we have rules. Let me give you an example. We're talking for years now about getting private investors back in the mortgage market. Why would any rational investor put money at risk if the Attorney General can show up and take money from you?
Okay.
There's no reason to do it.
All right, let's bring in Arthur Wilmarth to join this conversation. He's a professor of law at George Washington University. I know, Arthur, that you've been listening in on this conversation. What do you say to what Chris has been saying, and also what Dick Kovacevich said earlier today?
Well, first of all, there are two groups of people whose opinions you have to change. One is the senior executives. Senior executives have to be held responsible. If senior executives are not held responsible, why would their successors act differently? But the other group that you have to change is large institutional investors, including pension funds, including mutual funds. And so I think what the government has done in levying large civil penalties against these three banks was necessary but not sufficient. It brings to the shareholders' attention that there was pervasive and systemic wrongdoing at these banks. And what is most shocking, the wrongdoing continued even after the crisis broke out. So the allegations include allegations, actually admitted facts, that they continued to sell shoddy and fraudulent mortgages to the Federal Housing Administration after the crisis broke out. Their basic conduct did not change, and that's very shocking.
Well, let me turn the conversation back to Mr. Whalen. I mean, get you to react to what Arthur just said, but the very same shareholders whom you say are now paying and bearing the responsibility were shareholders who made a lot of money at Countrywide and at Merrill Lynch over the years through the practices that are being sanctioned today. And secondly, some of those very same shareholders in those banking companies benefited from taxpayer bailouts, didn't they?
Well, they did, but let's also remember that these large public companies bought these crippled financial institutions. You know, in the case of Countrywide, the firm would have failed if Bank of America hadn't bought it. Bear Stearns, WAMU were bought by J.P. Morgan.
But Bank of America moved to buy Countrywide before the crisis was in full flower.
Well, yeah, but they were the warehouse lender for Countrywide, Tyler. Countrywide had nowhere else to go. The firm definitely would have failed if it hadn't been acquired.
All right. I would like to get Arthur back in. To what extent have these actions by the government, you think, changed behavior? So if something like this were to happen again, whether it's financial institutions or other institutions, do you think that these fines have been enough to deter bad behavior?
Well, the three settlements have been quite recent, so it's early to tell. I mean, I think one thing we need to look for is whether shareholders, the large shareholders, will seek themselves to hold the senior executives accountable. So far, I don't think you can be confident that we have changed behavior. No. I agree with Chris that you need to hold senior executives accountable. The government has the tool to do that, which is civil money penalties under the same statute, and they need to do that. But I think that Chris made an important observation, which is that these three banks were warehouse lenders to all the subprime lenders. They then packaged all the securities and sold them, as we now know, under fraudulent and deceptive representations and warranties. Okay. So they were deeply embedded in this from the very beginning.
Yep. Well, it's a conversation that's going to obviously continue for many years on. History will tell which is the right way to go on this. Gentlemen, thank you both. Christopher Whalen of Knowles, a bond rating agency, Arthur Wilmarth from George Washington University. And still ahead on the program, the future of retail, why the mall of tomorrow will look nothing like it does today. Another unprofitable quarter for Sears, making this the 9th straight quarterly loss for the retailer. Its CEO, Edward Lampert, called the results, quote, unacceptable. The company, which operates both Sears and Kmart, says it plans to continue cutting costs, closing stores, and improving pricing and promotions. Shares fell more than 7% to $33.38.
And Sears, like many other retailers, trying to reinvent itself as consumer habits change. And since we, for the most part, just wrapped up the retail portion of the big earnings season, we thought it'd be a good time to examine the future of shopping. Here's Courtney Reagan.
The future of retail is now in the making. In Manhattan studios, Silicon Valley startups, and retail labs that look like any old store, but are smarter.
Physical retail is the temple for your brand. It'll feel a lot like your digital retail experience.
So if I'm a shopper and I've got this dress, I'm interested in this dress, I can come over to the screen over here, and the screen will pick it up and know what I've got in front of it. You can pick your size, And if you've logged in, you can add it to your fitting room. So what you're actually doing is creating a shopping cart, kind of like you do online.
The intersection of online information, physical product, and personalization from data analytics will redefine the retail experience. By opting in, retailers will know who we are, what we like, and how we buy as soon as we step inside.
As I move my feet, it creates artwork on the screen.
And personalization will be paramount, like customizing a pair of Converse for every shopper in the store.
The store knows who you are when you come in. They can promote to you individually based on your buying preferences, based on your history, based on what they think you'll react to each individual promotion.
While it may be a challenge for retailers now, 25 years from now, the separation between digital and physical will no longer exist. Smart storefronts that sense what sports teams you like and display the team jersey to prompt a purchase. Digital halos around every product that tell a story, where it comes from, how it was made, and peer reviews of its performance. Powered by your personal preferences and particulars, smart shelves will also protect you.
That intelligent shelf understands that your daughter has a nut allergy, which is really incredibly dangerous. Now imagine that every single product in the store that has nuts in it, peanuts in it, or was made in a factory that had it, they all go dark.
And through all these experiences, the consumer will be in control.
I think it's all going to come down to choice for the consumer. So I don't think it's a world where you're purely going to walk in and a robot's going to hand you the shirt that you browsed online. There's going to be people that do want that human-to-human interaction. I think the difference is they'll actually be able to order it on demand whenever they want it, their way.
For Nightly Business Report, I'm Courtney Reagan.
And that is Nightly Business Report for tonight. I'm Susie Garrett. Thanks for watching.
And thanks from me as well. I'm Tyler Mathisen. We hope you have a great evening, and we'll hope you come back tomorrow night.
I'm Susie Garrett with the Nightly Business Report News Brief. Stocks close higher for a fourth straight session, with the S&P 500 hitting a new high after investors were encouraged by a batch of positive economic data. The Dow rose 60 points to break back above 17,000. The Nasdaq added 5, and the S&P tacked on 6 to 1992. That's a new record. Family Dollar has rejected Dollar General's $9 billion buyout offer over antitrust concerns, but it reaffirmed its support for an $8.5 billion bid from rival Dollar Tree. eBay shares jumped about 5% on a report the company is getting ready to spin off PayPal, its fast-growing payments unit, as soon as next year. And shares of Sears got hammered, falling more than 7% after its 9th straight quarterly loss. Be sure to tune into Nightly Business Report right here on your public television station.